are moments in professional life when years of accumulated work and sacrifice suddenly concentrate into a single decision, when abstract questions about values and integrity that seemed purely theoretical during ordinary operations become immediately concrete through offers that make compromise financially rational. When the gap between who you claim to be and who you're willing to become gets measured in specific dollar amounts displayed on screen in boardroom with people waiting for your response. Adrian Cole experienced such a moment on a Tuesday afternoon in late September, sitting in a glass-walled conference room on the 14th floor of an office building in the city's business district, looking at acquisition offer that represented more money than he'd ever imagined having personal access to, feeling the weight of decision that would determine not just his financial future but his understanding of whether the principles he'd claimed to be building his company around were genuine commitments or just convenient narratives he'd maintained when maintaining them didn't cost anything significant. The number on the laptop screen was $47 million. Not approximate figure, not rough valuation subject to negotiation, exact number, carefully calculated by investment analysts who'd spent weeks examining his company's financials and market position and growth trajectory, who determined that this was fair price for acquiring the business he'd spent 6 years building, who'd structured the offer to be compelling enough that rational person would accept while not being so generous that it suggested desperation or poor judgment on the acquirer's part. $47 million, which after taxes and after accounting for investor shares and employee stock options would leave Adrian personally with approximately $31 million, which was more money than his parents had earned in their combined lifetimes, which was enough to never work again if he chose not to, which was the kind of transformative wealth that changes not just immediate circumstances but generational trajectories. Adrian was 34 years old, had founded TrueMetric 6 years earlier while working full-time at a software company whose products he'd found ethically troubling, whose business model had been based on collecting user data and selling access to that data to third parties who used it for targeted advertising and behavioral manipulation. He'd started TrueMetric as side project, as attempt to build analytics software that provided genuine value to users without requiring them to surrender their privacy as payment, that operated on transparent subscription model rather than on hidden data extraction model that characterized most free software services. The project had been motivated more by frustration with existing tools than by ambition to build significant business, had just been an attempt to create something that worked the way Adrian thought software should work, that treated users as customers deserving respect rather than as products to be monetized. The first 2 years had been difficult in ways that tested Adrian's commitment to his principles. Operating on subscription model meant slower growth than competitors who could offer free services subsidized by data monetization. Being transparent about data practices meant educating potential customers about issues they often didn't understand or care about. Refusing to compromise on privacy protections meant turning down partnership opportunities and distribution channels that could have accelerated growth but that would have required relaxing the standards Adrian had established. The company barely survived those first 2 years. Adrian was working 60-hour weeks between his day job and TrueMetric development, was funding operations from his savings and from small angel investment round he'd raised from friends and former colleagues who believed in the mission even when the business case wasn't clearly compelling. But gradually, the approach had started working. Increasing public awareness about data privacy created market for tools that didn't exploit users. Regulatory changes in Europe and California created competitive advantage for companies that were already compliant with emerging privacy standards. Several high-profile data breaches at major tech companies created skepticism about free services that made Adrian's subscription model seem less eccentric and more prudent. TrueMetric's growth accelerated, never achieving the exponential hockey stick curves that venture capitalists looked for, but maintaining steady sustainable expansion that allowed Adrian to quit his day job and hire a small team, that allowed the company to achieve profitability within 4 years, that created foundation for building real business rather than just venture-funded growth experiment. By year 6, TrueMetric employed 43 people, served approximately 12,000 paying customers ranging from small businesses to mid-sized enterprises, generated about $8.5 million in annual revenue with profit margins around 15%, and had built reputation in its niche as company that could be trusted, that delivered reliable product without hidden costs or exploitation. The business wasn't spectacular by Silicon Valley standards, wasn't growing fast enough to interest most venture capitalists, wasn't operating in large enough market to justify massive valuations, wasn't building toward acquisition or IPO that would generate returns for investors who demanded exponential outcomes. But it was real, was sustainable, was providing genuine value to customers while supporting a team of employees who believed in what they were building. The acquisition offer had come from Vantage Analytics, a much larger company in the same general market space, publicly traded, operating with typical data monetization business model that made Adrian uncomfortable, but that was completely normalized within the industry. Vantage had approached TrueMetrics several months earlier, had initially expressed interest in partnership or integration, had then escalated to acquisition discussions after their CEO had apparently decided that acquiring TrueMetrics' customer base and reputation for ethical practices could help address growing concerns about Vantage's own data practices. The $47 million offer reflected not just TrueMetrics' current financials but Vantage's calculation that acquiring company with strong privacy reputation could be worth significant premium if it allowed Vantage to credibly claim they were taking privacy seriously. The boardroom where Adrian sat reviewing the offer was generic corporate space, large table, comfortable chairs, screens for presentations, floor-to-ceiling windows overlooking the city, everything designed to communicate professionalism and success without any distinctive character that would make it memorable. 5 people sat across from Adrian, 2 senior executives from Vantage Analytics, their external legal counsel, and 2 representatives from the private equity firm that had led TrueMetrics' series of funding round 18 months earlier and that held approximately 35% of the company's equity. The private equity representatives, a woman named Jennifer Park and a man named Michael Torres, had been instrumental in arranging this meeting, had been actively encouraging Adrian to consider acquisition possibilities for the past 6 months, had made clear their view that TrueMetrics' growth trajectory was too slow to justify the returns they needed from their fund, that selling to larger company made strategic sense given market dynamics, that Adrian's resistance to this obvious exit was emotional rather than rational and was preventing everyone from realizing appropriate return on the work and investment that had built the company to this point. Adrian had his own laptop open in front of him, displaying the acquisition term sheet that had been sent the previous week and that today's meeting was meant to discuss in detail. The financial terms were straightforward, $47 million cash, paid at closing, with standard representations and warranties and non-compete provisions. But buried in the operational terms were conditions that had made Adrian increasingly uncomfortable as he'd reviewed the documents, provisions that would give Vantage control over product direction and business model, language that would allow operational optimization, that clearly meant potential layoffs, requirements that TrueMetrics would integrate with Vantage's existing data infrastructure in ways that Adrian knew would compromise the privacy protections he'd built the company around. He'd raised these concerns during preliminary discussions, had been told they were standard terms, had been assured that Vantage respected TrueMetrics' values and had no intention of fundamentally changing what made the product successful. But the assurances were verbal and vague, while the actual contract language gave Vantage essentially unlimited authority to modify TrueMetrics' operations however they deemed appropriate. And in follow-up conversations with other founders who'd sold to larger companies, Adrian had learned that post-acquisition, respect for the acquired company's culture and values almost never survived contact with the acquiring company's actual business priorities and operational requirements. David Chen, Vantage's Chief Strategy Officer, was leading the presentation. He was perhaps 45, dressed in business casual that communicated both professionalism and approachability, clearly experienced in acquisition negotiations and comfortable with the dynamics of persuading founders to accept offers they might be ambivalent about. He'd been walking through the acquisition rationale, how the combination would benefit both companies, how TrueMetrics customers would gain access to Vantage's resources and scale, how Adrian and his team would have opportunity to influence privacy practices across Vantage's much larger platform. The market is consolidating, David was saying, his tone reasonable and factual. Companies at TrueMetrics scale are increasingly finding it difficult to compete against larger players who have more resources and more established customer relationships. This offer gives you and your team opportunity to be part of building the future of ethical analytics at real scale, rather than being marginalized as a small player in a market that's increasingly dominated by companies that don't share your values. The argument was familiar. Adrian had heard versions of it multiple times during the months of preliminary discussions. And it contained legitimate points. TrueMetric was small, market dynamics did favor larger companies, maintaining independence would be increasingly difficult as competitors grew through funding or acquisitions. But the argument was also self-serving, was designed to make acceptance seem prudent while making resistance seem naive or stubborn. Jennifer Park, the private equity representative, reinforced David's points. Adrian, you've built something remarkable. But you've also taken outside investment, and that comes with obligations to your investors. The returns from this acquisition would be excellent for our fund and would validate the bet we made on you and your team. Turning down this offer means choosing continued uncertainty and slower growth in highly competitive market. That's your right as CEO, but you need to consider whether that's fair to the people who've supported you. The invocation of fairness and obligation was subtle manipulation, was attempt to reframe the decision as being about Adrian's responsibility to others rather than about his own values and judgment. And it contained truth. He had taken investment, investors did deserve reasonable returns, his decision would affect others beyond just himself. But the frame was designed to make acceptance seem like responsible stewardship while making resistance seem like selfish insistence on personal values at others' expense. Adrian had been largely silent during the presentation, had been listening carefully to how the offer was being presented, had been noting which arguments were emphasized and which concerns were dismissed or minimized. He'd learned over years of running TrueMetric that people revealed their actual priorities through what they chose to focus on versus what they chose to gloss over, that the structure of persuasion often communicated more than its explicit content. The presentation concluded. David looked at Adrian expectantly. We're excited about this opportunity and we believe you should be too. The terms are strong, the strategic fit is excellent, and this positions everyone for success. What questions can we address? Adrian looked at the number on his screen. $47 million. Thought about what that would mean concretely, never worrying about money again, buying a house, traveling, having time to pursue interests he'd deferred while building the company. Thought about his team members who'd joined TrueMetric accepting lower salaries than they could have earned elsewhere because they believed in the mission, who would receive significant payouts from their stock options if this acquisition closed. Thought about the investors who'd supported him, who would be professionally validated by this successful exit, who were sitting across the table clearly expecting him to accept, then thought about the actual terms. About the operational control provisions. About what would happen to TrueMetric's privacy protections once Vantage had authority to modify them. About the customers who'd chosen TrueMetric specifically because it didn't operate like Vantage operated, who trusted that their data wouldn't be exploited. About what acceptance would mean for his understanding of whether his stated commitment to ethical business practices had been genuine or had just been marketing position he'd maintain only when maintaining it didn't cost anything significant. What happens to our users' data after acquisition? Adrian asked. The term sheet includes language about integration with Vantage's infrastructure. Can you be specific about what that means for our current privacy protections? David's expression shifted slightly. The question was clearly expected but still unwelcome. We respect TrueMetric's approach to privacy and we have no intention of compromising what makes your product distinctive. But yes, there would be some operational integration required to achieve the synergies that justify this acquisition. We'd work with you to ensure that integration is done thoughtfully and in ways that preserve customer trust. That's not specific, Adrian said. Your current business model is based on data monetization. TrueMetric's model is based on not monetizing data. Those are fundamentally incompatible approaches. I need to understand specifically how you plan to resolve that incompatibility. There was pause. David exchanged glance with his colleague before responding. Look, we're not going to sit here and tell you that nothing would change post-acquisition. Of course things would change, that's how acquisitions work. We'd be integrating operations, optimizing costs, exploring opportunities to increase revenue. But we value what you've built and we'd work to preserve its core strengths while also bringing it into alignment with Vantage's overall strategy. Which means changing the privacy protections, Adrian said. Not a question, just statement of what the evasive language clearly meant. Another pause. It means finding appropriate balance between privacy protection and business sustainability. The reality, Adrian, is that pure subscription models limit growth in ways that make long-term sustainability difficult. Every company in this space eventually needs to find additional revenue streams. We'd help you do that in ways that are more sophisticated and less disruptive than you could achieve independently. By monetizing user data, Adrian said. By creating value from the data users are already providing, David replied, his tone showing slight frustration with Adrian's framing. Which is standard industry practice and which users accept when the value exchange is appropriate. Adrian looked at Jennifer Park. Is this what you expected when you invested? That we'd build company based on not exploiting users and then sell it to company that would immediately start exploiting them? Jennifer's expression was carefully neutral. I expected that we'd build valuable company and that we'd realize appropriate returns on that value through eventual exit. The specific terms of that exit are for you to evaluate as CEO, but our view is that this offer represents excellent outcome that you should seriously consider accepting. Adrian closed his laptop. The gesture was small but definitive, was physical manifestation of decision that had been forming throughout the meeting even though he'd been hoping some aspect of the discussion would resolve his concerns and make acceptance possible. I appreciate the offer and the time you've invested in this process, he said, keeping his tone professional despite the emotional weight of what he was about to say. But I can't accept these terms. The operational provisions would require compromising the privacy protections that are core to why TrueMetric exists. I'm not willing to do that. Silence filled the boardroom. The quality of the silence was distinctive, not just absence of speech but presence of genuine shock, of expectations being violated in ways that hadn't been anticipated. People made calculations about acquisition offers, sometimes negotiated for better terms, occasionally delayed decisions while considering alternatives. But outright refusal of $47 million on grounds of principle was outside the normal range of responses, was the kind of decision that suggested either unusual integrity or unusual foolishness depending on perspective. David recovered first. Adrian, I understand you have concerns about the specific operational terms. That's normal and we can discuss modifications. But let's be realistic about your alternatives. This is strong offer from well-positioned acquirer in consolidating market. Walking away from this likely means not getting another opportunity like it, means continuing to compete independently in an environment that's increasingly difficult for companies at your scale. I'd encourage you to think very carefully before making final decision. I have thought carefully, Adrian replied. 4 months. And my conclusion is that accepting this offer would betray the commitments I've made to our users and our team. The money is significant, I understand what I'm turning down. But I built this company because I believed software could operate differently than it typically does. Selling to company that would immediately change that undermines everything we've worked to create. Michael Torres, the other private equity representative, spoke for first time. His tone was harder than Jennifer's had been, carried edge that suggested he was less interested in persuasion than in making clear the consequences of Adrian's decision. You understand that turning down this offer will have significant implications for your relationship with your investors. We backed you based on expectation of reasonable returns within reasonable timeframe. This acquisition would deliver those returns. Choosing to continue independent operations in difficult market conditions is not the outcome we invested to achieve. I understand, Adrian said. And I'm sorry that my decision disappoints you. But when you invested, you knew TrueMetric was built on specific principles. I can't abandon those principles now just because maintaining them is no longer convenient. Principles don't pay returns, Michael said bluntly. Your responsibility as CEO is to your shareholders, not to abstract ideals about how you wish the industry operated. My responsibility is to build sustainable business that serves its customers well and treats them with respect, Adrian replied, his tone remaining calm despite the confrontation. That's what I've been doing for 6 years and that's what I'll continue doing. If that's not compatible with your investment expectations, I'm sorry, but I'm not changing course. Jennifer attempted to moderate. Adrian, no one is asking you to immediately abandon your principles. We're asking you to consider whether those principles can be maintained within larger organization that has different business model. Many founders struggle with post-acquisition integration, but many also find ways to influence their acquirers in positive directions. You'd have opportunity to push Vantage toward better privacy practices from inside the company. I've talked to founders who've tried that, Adrian said. It doesn't work. Acquired companies get absorbed into acquirers' culture and priorities. 6 months after close, I'd either be implementing changes I currently oppose or I'd be leaving in frustration. Either outcome means TrueMetric stops being what it is. The meeting continued for another 30 minutes, more arguments about market conditions, more assurances about respecting TrueMetric's values, more warnings about consequences of refusing this offer. But the fundamental positions didn't change. Vantage wanted to acquire TrueMetric to gain its customer base and reputation while converting its business model to data monetization. Adrian was unwilling to sell company only to watch it be transformed into the kind of business he'd created TrueMetric to be alternative to. No amount of discussion could bridge that gap. Eventually David acknowledged the impasse. I'm disappointed, Adrian. I think you're making a mistake and I think you'll regret this decision when you're still struggling to compete against companies that have more resources. But it's your decision to make. The offer will remain open for 2 weeks if you reconsider. After that, we'll pursue other opportunities. Adrian thanked them for their time, shook hands with appropriate professional courtesy, and left the conference room. Walked to the elevator, rode down 14 floors in silence, emerged into the afternoon sunlight feeling both relieved and terrified by what he'd just done. Relieved because he'd maintained integrity of the company he'd built, terrified because he'd just turned down generational wealth and had potentially damaged relationships with investors whose support he might still need. The immediate consequences were uncomfortable but manageable. Jennifer and Michael were clearly unhappy with Adrian's decision, made that unhappiness clear in subsequent board meetings, but didn't take any drastic actions that would have forced immediate crisis. They remained involved as board members, continued to provide advice when asked, but their relationship with Adrian had cooled substantially, had shifted from partnership toward monitoring relationship where they were clearly waiting to see if his refusal of the acquisition offer would be validated by TrueMetric's future performance or would prove to have been costly mistake. Some of Adrian's team members left. 2 senior engineers who'd been with the company since early days, who'd been counting on acquisition payout to fund their own startups or to provide financial security for their families, resigned within 3 months of the failed acquisition. They were professional about it, didn't express anger or accuse Adrian of betraying them, but the implicit message was clear. They'd joined TrueMetric accepting below-market compensation with expectation that equity would eventually provide return through acquisition or IPO, and Adrian's refusal to sell had eliminated that near-term possibility, had made their equity significantly less valuable, had meant they'd sacrificed years of higher earnings for outcome that now seemed unlikely to materialize. Their departures hurt both operationally and emotionally. Operationally because they were experienced contributors whose knowledge and relationships would be difficult to replace. Emotionally because their leaving felt like judgment on his decision, felt like evidence that maybe Michael Torres had been right about his responsibility being primarily to shareholders and employees rather than to abstract principles that cost other people money. But others stayed. About 2/3 of the team, including several people who would have benefited substantially from the acquisition payout, remained with TrueMetric. Some because they believed in the mission and were willing to accept longer timeline to potential returns. Some because they valued working environment and product direction more than they valued immediate financial outcome. Some because they trusted Adrian's judgment even when they weren't entirely certain he'd made right choice. And TrueMetric continued operating. Not spectacularly, growth slowed as market consolidation that David had warned about did occur, as competitors with more resources and less restrictive business models expanded their market share, as some potential customers chose larger vendors despite preferring TrueMetric's approach because they worried about betting on smaller independent company in consolidating market. But the company remained profitable, continued serving its customers well, continued building reputation as trustworthy provider in market increasingly dominated by companies whose trustworthiness was questionable. Adrian's personal financial situation remained modest. He paid himself reasonable salary as CEO, enough to live comfortably but nothing like what $31 million would have provided, nothing that would have eliminated future financial concerns. He rented apartment in nice but not expensive neighborhood, drove aging car that he kept maintaining rather than replacing, lived within his means while putting modest amounts into retirement savings. The lifestyle was fine, was significantly better than what he'd had during TrueMetric's early struggling years, but was also a reminder of what he'd chosen not to have, was evidence of the cost of his decision every time he considered buying something and had to evaluate whether it fit his budget. The media attention that might have accompanied successful $47 million acquisition never materialized. TrueMetric remained relatively unknown outside its niche, was never featured in mainstream business press, never became example of startup success that other founders studied. Adrian was fine with this, had never been motivated by desire for recognition or public validation, but sometimes wondered whether the invisibility meant his approach wasn't actually viable, whether the lack of spectacular success meant he should have compromised, whether maintaining principles at cost of growth was actually wisdom or just stubborn insistence on approach that market had demonstrated wasn't optimal. 3 years after refusing the acquisition offer, TrueMetric was still operating. Still had about 40 employees, some turnover from the immediate post-acquisition period but relatively stable team. Still served approximately 15,000 paying customers, growth had slowed but hadn't reversed. Still generated about $11 million in annual revenue with profit margins around 12%, enough to be sustainable but not enough to justify the kind of valuation that would interest new investors or acquirers. Still maintained the privacy protections and subscription business model that Adrian had refused to compromise. Vantage Analytics, meanwhile, had acquired a different competitor, had integrated that acquisition in exactly the ways Adrian had feared they'd integrate TrueMetric, had converted the acquired company's previously privacy-respecting product into data monetization platform that technically still functioned but that had lost the trust that had made it valuable. Several of the acquired company's customers had switched to TrueMetric specifically because they'd been upset about the changes Vantage had implemented post-acquisition, had told Adrian they were glad TrueMetric hadn't sold, had said they needed alternatives to companies that exploited their users. Those customer conversations validated Adrian's decision in ways that financial outcomes hadn't. Confirmed that maintaining principles had created value that market did recognize even if that value wasn't being converted into spectacular financial returns. Confirmed that the trust he'd refused to betray did matter to at least some portion of the market, that his refusal to sell to Vantage had preserved something that had concrete value to real users even if that value wasn't reflected in TrueMetric's valuation. 5 years after the refused acquisition, Adrian was 40 years old, still CEO of TrueMetric, still running company that was smaller than it could have been if he'd been willing to compromise but that remained sustainable and respected within its niche. The private equity investors had eventually exited through secondary sale, had sold their shares to a group of individual investors who were willing to accept lower returns in exchange for investing in company whose values they supported, who didn't pressure Adrian to pursue growth strategies that would require abandoning the principles TrueMetric was built around. The company employed about 55 people, generated approximately $14 million in annual revenue, served about 18,000 customers. The growth trajectory was steady without being impressive, was the kind of sustainable expansion that characterized healthy businesses but that didn't create excitement among investors or media who were looking for exponential curves and dramatic exits. Adrian's personal wealth remained modest, his equity in TrueMetric had significant theoretical value if the company ever sold, but he had no plans to sell, and the theoretical value didn't translate into liquid assets that would change his day-to-day financial circumstances. He'd never bought the house he'd once imagined. Had never stopped working because he didn't need to work. Had never experienced the financial freedom that $31 million would have provided. Sometimes wondered about the alternative timeline where he'd accepted Vantage's offer, where he'd spent the past 5 years wealthy and retired or working on new projects, where he wasn't still managing the daily challenges of running small company in competitive market. But he also had things that money wouldn't have purchased. Slept well, didn't lie awake troubled by compromises he'd made or harms he'd enabled. Maintained trust with his team, the people who'd stayed had done so because they believed in what they were building, created work environment characterized by mutual respect and shared purpose rather than by purely transactional relationships. Could look customers in the eye, knew that TrueMetric actually delivered on its promises, that users who trusted the company weren't being exploited or betrayed. These weren't tangible assets that could be quantified on balance sheet. Weren't outcomes that impressed investors or that generated press coverage. Weren't achievements that society typically celebrated or that business schools taught as examples of success. But they were real, were valuable to Adrian in ways that made the cost of his decision feel bearable even when that cost was substantial. He occasionally encountered other founders who'd made different choices, who'd sold their companies and who were now dealing with post-acquisition regret. Some had become wealthy but were working for acquirers whose values they didn't share, were implementing changes they'd opposed, were watching their creations be transformed into things they wouldn't have built themselves. Some had left their acquirers after brief integration periods, were starting new companies or retiring early, were financially set but carrying complicated feelings about what they'd enabled or betrayed. None of them said they regretted selling. That would have required admitting that trading integrity for money had been a mistake, would have been psychologically costly given that the decision couldn't be reversed. But their complicated feelings suggested the trade-off wasn't as straightforward as simple financial comparison would suggest. Adrian continued running TrueMetric. Continued making daily decisions about product direction and business strategy, continued managing team and responding to customer needs, continued navigating competitive market that rewarded different approaches than the one he'd chosen. The work was ongoing, would likely continue for years unless he eventually decided to sell or unless market conditions changed in ways that made TrueMetric's independent operation unsustainable. But for now, the company continued. The principles he'd refused to compromise for $47 million remained intact. The trust he'd maintained with customers and team remained real. The sleep he got at night remained undisturbed by regret about choices made under pressure. These weren't spectacular outcomes, weren't the kinds of achievements that would make compelling success stories, weren't results that would convince others to make similar choices. But they were enough. Not enough to eliminate doubt about whether he'd made right choice, not enough to prove that refusing acquisition had been wise rather than stubborn, not enough to demonstrate that maintaining principles in business was actually viable strategy rather than just fortunate exception. Just enough to continue, to maintain the company he'd built according to the values he'd established, to preserve the possibility that business could operate differently than it typically does even when operating differently means accepting limitations that compromise would eliminate. Not every victory comes with applause. Some come with peace. The quiet knowledge that you maintained integrity when compromise would have been easier and more profitable, that you kept commitments when breaking them would have been financially rational, that you preserved trust when betraying it would have made you wealthy. These aren't outcomes that society celebrates or that business culture rewards. Aren't results that create magazine covers or conference keynotes or case studies in business schools. But they're real. They're valuable in ways that financial returns don't capture, in ways that can't be quantified on balance sheets or included in investor presentations. They're what allow you to sleep at night, to maintain relationships based on trust rather than transaction, to build organizations that create value without creating harm. They're what distinguish running a business from just extracting returns from market opportunities without regard for broader consequences. Adrian's decision to refuse $47 million wasn't heroic. Wasn't obviously correct. Cost him and others real money and real opportunities. Maybe was mistake that he'll regret more clearly as years pass and as opportunity cost of his choice accumulates. Maybe would have been wiser to accept the offer, to take the money, to trust that the principles he valued could be expressed through different means after achieving financial security that would make future principled stands less costly. But maybe the cost itself is the point. Maybe principles that aren't tested by meaningful sacrifice aren't actually principles, are just preferences maintained when maintaining them is convenient. Maybe the question isn't whether refusing the acquisition was optimal decision but whether it was authentic expression of the values Adrian claimed to be building his company around, whether it demonstrated that his stated commitments were genuine rather than just marketing positions he'd maintain only until maintaining them became expensive. Most people facing similar choices accept the money. Take the acquisition, implement the changes, rationalize the compromises, move forward with wealth and with complicated feelings about what they enabled. That's rational. That's normal. That's how careers advance and fortunes are built and how individuals navigate systems that reward particular behaviors while punishing others. But some people refuse. Choose peace over profit. Choose integrity over returns, choose to continue struggling in ways that could be eliminated through compromise. Not because they're better or more moral or more worthy of admiration. Just because they've decided that some things matter more than money, that maintaining certain commitments is worth certain costs, that building organizations that operate according to particular values is worth the limitations that come with refusing to violate those values. You won't know if such choices are right until long after they're irreversible. Won't receive clear validation that maintaining principles was wise. We'll just continue living with the consequences, both the costs and the benefits, of decisions made under pressure about who you are and what you value and what you're willing to preserve even when preservation requires sacrifice. Not every victory comes with applause. Some come with peace. Be story-wise.